7 minutes before showtime. I'm thinking to myself, well, I guess I'm going to be late, and there you go. So, some this is the probate administration game here. So I'm glad to be able to join you on time. Just want to let you know that the show is sponsored by Probate and Trusts TV. This is a new venture that brings together all the best video content on YouTube on the subjects of estate planning and trust and estate administration. I'll talk a little bit more about that later in the show. So today I'm going to be talking about, my topic is executor duties, and in particular, it is filing an estate tax return, what's better known, or what's also known as a Form 706 or just 706. So like the regular income tax return known as the 1040, it goes by that designation. An estate tax return goes by its form number 706. Now, as those of you who've watched the show before know, I am not an accountant or a lawyer. I'm not going to be talking about this from an accounting or legal standpoint. I'm going to be talking about it from an administration standpoint. And the reason that's important is there are lots of laws, tax laws that potentially need to be complied with. There may be some legal issues. All of those are important. But as an administrator or personal representative, whether you're an executor or a court-appointed administrator, you have the responsibility for seeing to it that a 706 is filed if it's required. Okay, so it's not the accountant's duty to see that it gets filed. It's not the lawyer's duty. It is the personal representative's duty. Okay, and to not file that particular tax return would be, in essence, a breach of fiduciary duty, or to file it late and incur a penalty for late filing would also be, a problem for the administrator. Okay, so that's the perspective that I'm going to be taking this morning, or well, it's not morning on the East Coast, but that I'm going to be taking today as we talk about this. Okay, so first of all, just to real quickly. The federal government and still maybe 3 or 4 of the 50 states collect an estate tax in certain circumstances. Now, I'm not going to be talking about estate tax filings, okay, because the vast majority of states do not have an estate tax, but the federal government does. And in the Jobs Act of 2019, I believe it was, or 2018, this was the tax legislation that's up for renewal this year. The exemption from federal estate tax was increased quite a bit. And for 2024, that federal exemption is $13.61 million. So if the decedent's estate is less than that, then it's possible and maybe even likely that no estate tax return, no 706 has to be filed. Okay. However, even if the estate falls below the exemption level, there still may be a reason why it needs to be filed. And so the first step as a personal representative to take is to determine whether in fact a 706 needs to be filed. And it would be best to do that in consultation with an accountant, right? Who, not just any accountant, but an accountant who really knows estate taxation. Okay, so estate taxes are a specialty in the accounting world. Okay. And so many accountants do not have that as part of their experience and knowledge. And so you need to find someone, for example, like my colleague Roy Gia, who's been on the show, who really knows how the estate tax system works, what the laws are, etc. Okay, and I'll put a link to Roy's show in the show notes for those of you who would like to learn more about the accounting side of it. Okay, now in some cases, so for example, if a spouse whose spouse has passed away, uh, the surviving spouse, that's the term I'm looking for. A surviving spouse may need to file a 706 in order to elect what's called portability of the deceased spouse's unused exemption. Okay. So, for example, let's say that a spouse dies and his estate amounts to $10 million. Okay. So that uses only 10 of the $13.61 million exemption for last year. Now it's going to be higher for this year. I'll use $14 million just as a round figure for this year. I'm not saying that figure is 100% accurate. I'm going to use this for example. Okay. So a spouse dies this year, 2025, has a $10 million estate. So that leaves $4 million of the deceased spouse's exemption still available to the surviving spouse. But that leftover exemption needs to be ported over to the surviving spouse. And so it may be that a 706 will need to be filed. Okay, that's one of the ways. Now, again, this is an accounting issue, and so this is why you want to confer with an accountant to see, number one, is there part of the unused exemption that's portable in the sense of being able to be moved over, and if so, what needs to be done to accomplish that. Okay, again, as a personal representative, you have fiduciary responsibility for this. So to ignore this issue could be a big problem, all right? Especially when you think about it, if there's $4 million in exemption that can be ported over, that is saving, hold your hats, $1.6 million in taxes because the estate tax rate is 40%. Okay, so to neglect the potential portability of an unused exemption, okay, would be to essentially create a situation where the surviving spouse, when he or she dies, her estate or his estate pays a lot more taxes. Okay, and the heirs would not be happy about that. Okay, all right. So that's number one. Determine if a 706 is required. Number two, excuse me. Collect estate tax information. Okay, so this is really just fulfilling one of the fundamental responsibilities of a personal representative. So you need to identify all the assets. You need to identify all the debts. Okay, that gives you the gross value of the estate. However, there are additional factors that need to be determined for the accountant to prepare the 706. And that includes the expenses that the estate has borne for various reasons. So the estate may have paid or reimbursed funeral costs. There were probably legal and accounting fees. There were fees to the personal representative, what may be called executor fees or administration fees. There are court costs for if a probate had to be filed. Okay. Now, by the way, even if the assets are in a trust, so they're not going through probate, assets being in a trust does not exempt them from estate taxation. Okay. Nor, by the way, does, let's say there's a bank account and it has a beneficiary on death designation. That does not remove that asset from the gross value of the estate. The beneficiary is going to get the funds in that account tax free, but the reason they're going to get it tax free is because the estate has paid taxes on it, or it's within the estate tax exemption, and so it wasn't taxable at the estate's level. Okay, so there may be some fees associated with these things, administrating the trust, administrating a beneficiary on death process. Okay, so all of there could be, by the way, appraisal fees. Okay, probate referee fees. All of these, okay, may be deductible. Okay, on the 706. And so that information needs to be collected by the personal representative and given to the accountant so that the accountant can make an assessment of what needs to be deducted from the gross value of the estate. Finally, transfers and or gifts that were made prior to death, okay, or transfers to certain trusts, those kind of things. All of that information needs to be gathered and given to the accountant so an accurate 706 can be compiled. Okay, so you as the personal representative or as the fiduciary, like me, I'm a professional fiduciary, right? It's my responsibility to gather all that data. Okay, next, every asset in the estate must be valued, okay, typically as of the date of death of the decedent. Okay, now here's the thing. If the gross value of the estate exceeds the exemption limit, okay, it's very likely the estate is going to go through a level 1 audit, which means the IRS is going to look through the return very carefully. Okay, so earlier this month, through the estate's accountant, I submitted an estate tax return on a large estate. It's about a $50 million estate. Okay, the return was a stack of papers about this tall, so about 12 to 14 inches tall. Now, one of the reasons was because we included copies of all the appraisals on all the property in the estate, including appraisals of stock and bond portfolios as of the date of death, okay, and appraisals of all the real estate, and appraisal of a business owned by the estate. Now, all of these appraisals needed to be done by qualified appraisers. Okay. Now, the stocks and bonds are actually done through an online program, and my accountant, Roy, who I mentioned a minute ago, okay, he uses the same program that the IRS uses, which is a good idea, right? Because the IRS sees it and says, okay, this must be legitimate, right? We can check that one off, right? Because it was done by the same system we use. Okay, but for real estate appraisals, okay, here in California, as I've talked about on other shows, we have something called a probate referee who is, in theory, able to appraise accurately any kind of asset. In practice, that is not the case. And one of the problems then is that you can get a valuation done by a probate referee, but it's unlikely the IRS is going to recognize that as a valid valuation of an asset. And so, because of a law from 1989 called FIREA, the Financial Institutions Reform, Recovery, and Enforcement Act, real estate appraisers are now licensed in all 50 states. And the IRS broadly recognizes licensed appraisers as being qualified to do appraisals that are being submitted for, among other things, on an estate tax return. Okay. Now, there are professional associations that grant what are called certifications. There's something called member of the Appraisal Institute, MAI. The Society of Real Estate Appraisers also has a designation. But these days, it's unlikely that an MAI or another professionally designated appraiser, it's unlikely they don't also have a license. And so it's really the state license that's going to be most relevant. So if there's commercial real estate, meaning, retail, office, industrial, special use, or even large apartment buildings. Okay. Well, I'm sorry. Let me take out large apartment buildings. Okay. So any of the other ones I mentioned, those are going to have to be appraised by a certified general real estate appraiser. Now, I used to do that kind of work in my previous business, it's some of the most fun work you can do as an appraiser. Now, for homes, okay, so there's a lower level license that residential appraisers can get. And it's I forget what it's called. And then there's kind of a mid-level one for appraisers who appraise 5+ unit apartment buildings. Okay. Now, some appraisers only do commercial property, some only do residential, some do all types of property. Okay, but the main thing is they need to be properly licensed. So a licensed residential real estate appraiser, if that appraiser appraises an office building, that's not going to, very unlikely to pass muster. Okay, because they're not properly licensed. Okay, and so as opposed to a certified general who's certified to appraise any type of property. Okay, so if they appraise a house, they're qualified to appraise that. If they appraise a 4-unit apartment building, they're qualified to appraise that. So they need to be qualified. Okay, and I would recommend as well that they have experience appraising properties going through probate, because in most cases they're going to be doing a retrospective valuation, meaning the decedent died, let's say, January 31st. Here it is, it's April 28th today, right? That's 3 months later, basically. Okay, a typical appraisal is done, the value is done as of the date that the property is inspected, walked through. Okay, a typical appraisal for a 706 is going to be done retrospectively, meaning I'm seeing the property today or tomorrow, whatever, right? But the value is at some point back in time, and that's a special skill, and not all appraisers have done that type of appraisal work. Okay, so that's number two. Now, there may be other types of appraisals that have to be done, not just real estate appraisals. Now, with real estate appraisals, there is a licensing regimen. For other types of property, there is not. And so it's really going to come down to the experience and credentials that the appraiser has. The best credential is going to be that they've done a lot of appraisals that have been submitted to the IRS, and find out how often has the IRS challenged their work and how has that ended up. Okay, so if there's what's called a closely held business, so that's a business that its ownership is held privately. So as opposed to a company like Apple, Apple's stock is traded on a stock exchange, we know at any given time what the total value of Apple is, because we take the number of outstanding shares times the share price, and that gives us what's called the market capitalization for that company. That's what the company is worth. For a business whose shares are not traded on a public exchange, we can't do that. And so they have to be appraised. They have to have an appraisal done in not unlike how real estate is appraised. Okay. Now, the challenge is that even for a small business, it's a lot of work to appraise a business. And so they can be pretty expensive. Okay. But The reality is, if you use just kind of a rule of thumb for valuing a business, and then the IRS scrutinizes that, okay, if the estate is subject to estate taxation, they could very likely challenge that appraisal. And so you're being somewhat penny wise and pound foolish by not hiring a qualified appraiser and paying the fee. Okay, so now I will say that rules like uh, having the knowledge to do a retrospective appraisal, that applies to all qualified appraisers. Okay, so what are called the uniform standards of professional appraisal practice apply to anyone who represents himself as an appraiser. If you hire someone as an appraiser and they do not include in the report a USPAP compliance statement, that appraiser, you know, they're not appraising in accordance with proper appraisal standards. Okay, excuse me. Now, we talked about real estate, we talked about closely held businesses, and then there can be all kinds of other stuff. Art, collectibles, I've talked about horses several times, okay, cars. So anything that is of value may need to be anything that is of value needs to be appraised. Now, clothing, furniture, just regular furniture, those kinds of things do not need to be valued. The IRS recognizes, unless it's some kind of antique or some type of very valuable piece of clothing. Maybe you have Dorothy's ruby slippers that you bought from the movie The Wizard of Oz. Okay, that's more of a collectible. You don't need to appraise that kind of everyday stuff, but anything art, collectibles, like I said, valuable animals, cars, all those things need to be valued. By the way, crypto assets as well, all digital assets, those need to be valued as well. Okay, now there is an option for getting appraisals done of assets of an estate, whereby you can use an alternative valuation date that's 6 months after death, if it reduces the amount of tax, the estate would pay. Here's the rub. You can't interchange. You can't, appraise them as of date of death and of 6 months after date of death, and then choose the lower of the lower value for each individual property. They either all have to be date of death or all 6 months after date of death. Okay, so it's somewhat of a judgment call as to whether you go to the expense of getting two different appraisals on the two different valuation dates. That's something to discuss with your accountant. And if there's real estate involved, for example, there's probably a real estate broker involved. Especially if some of the property has to be sold, it's something to discuss with your real estate broker to get their opinion as to what is the likelihood that the property values went down. Okay, now I'm going to take a break here for just a minute and do two quick things. So first of all, this is Trust and Estates Weekly. We're here every Monday at 10 a.m. Pacific time, and for those of you who are practitioners in this field, I invite you to join my LinkedIn group called, interestingly enough, Trust and Estates Experts. Right? Show and the group have the same name. So this is a LinkedIn group where professionals get together. We can ask each other questions, extend professional courtesy, exchange leads, all by way of helping each other do a better job serving our clients. So if you're interested in joining, just go to LinkedIn, search in groups, Trust and Estates Experts, click a request to join, and I'll be happy to admit you to the group. Also, if you prepare content related to estate planning and trust and estate administration, so it's a good place to post your content. It'll get you additional exposure, allow you to share your expertise, and that's all for the betterment of the members of the group. So once again, that's on LinkedIn. It's a group called Trust and Estates Experts, and I invite you to join. Now, today's show is brought to you by, for those of you who are from the 60s and 70s, you know this commercial pitch, right? Probate and Trust TV. So this is a new venture that I started to aggregate video content on YouTube on estate planning and trust and estate administration. So you can strengthen your expertise with Probate and Trust TV, learn practical strategies in estate planning, probate administration, tax strategies, tax compliance, fiduciary duties, real estate, and more from top practitioners, including real estate broker and host of Probate Weekly, Bill Gross, and estate planning attorney, Paul Rabelais, and of course, yours truly. So you'll get actionable insights you can apply immediately to better serve your clients and grow your practice. So subscribe today at youtube.com/@ the @ Probate Trust TV, and stay ahead of the competition in this complex and changing field. So as the compiler of Probate and Trust TV, I hope you'll check it out and subscribe, and that way you will never miss great content, not just from the producers I mentioned, but from many others as well. Okay, so back to our topic then, which is preparing an estate tax return. So next, after you've valued the property, the assets in the estate, you need the accountant is really going to take over, and he's going to calculate deductions and credits that could potentially reduce that will reduce the estate's taxable value. So I mentioned some of these before, but there's marital deduction. There could have been a porting over of unused exemption from a previously deceased spouse. There could be charitable deductions if the estate made some charitable contributions, debts and expenses I talked about. And if the state collects an estate tax, that may be deductible on the federal estate tax return on the 706. Okay, so all that information needs to be gathered by you, the personal representative. Okay, credits might include gift taxes previously paid, foreign estate taxes, and credit for taxes on prior transfers. So fiduciaries, we're not experts in all the details of taxation, but we need to be the gatherers of information. So we may need to track down previously filed income tax returns that deal with some of these issues, like gift tax previously paid, etc., so the accountant can then do the proper job in calculating what the tax liability is. Okay, so once your accountant has calculated deductions and credits, you've done the research needed to do that. Okay, now the accountant is going to prepare and file the Form 706. Okay, now there's going to be lots of questions the accountant has, and as the personal representative, it'll be your obligation to confer with the accountant, answer those questions. If you don't know the answers, find them out, do the research, etc., etc., etc. Okay, not unlike filing an income tax return, of which we're all at least somewhat familiar, right? There are numerous questions that have to be answered in order to file an accurate return. Okay, so a couple things about filing the return. First of all, it's due 9 months after the date of death. Okay, so again, going back to the example I mentioned a little while ago, if the person died on January 31st, then the return is going to be due February, March, April, May, June, July, August, September, October. It's going to be due October 31st. Okay. Now, there is an automatic extension available if Form 4768 is filed, so you can get an extra 6 months to file. Very similar to the automatic extension one can get for filing an income tax return, with one difference, okay? And that is you may not have to pay the estate taxes in order to avoid penalties for paying them late on if you apply for the extension. So this is the details of this is something to discuss with your accountant, but there may be insufficient liquidity in the estate to be able to pay the estate taxes 9 months into administration. Okay. And so the IRS, or I should say the Internal Revenue Code, provides a mechanism to delay paying the taxes without penalty. Now, that doesn't mean you avoid interest. You'll pay interest on the taxes owed, but you won't pay penalties. That is different than income taxes. Okay. Now, here's another difference between filing a 706 and a 1040. And that is, these days, I think most people file their 1040 electronically. A 706 cannot be filed electronically. It has to be filed in a paper filing. Okay. I mentioned that one that I filed earlier this month that was 12, 14 inches tall. It was put into a cardboard box that was sent to the IRS. The postage was, I think, close to $200 for mailing, that stack of papers. Okay. And so that's another difference between an income tax return and an estate tax return. And then, like all returns, the return needs to be signed. And in this case, the executor or personal representative, the administrator, that is the person who will sign the return. It's going to be a wet signature, right, with a pen, right? Okay, this happens to be a real wet signature because it's a fountain pen. But I went and met with my accountant and I signed the various forms. Okay, so whereas with an electronic filing, you're not signing it with a wet signature, you're signing it electronically. Or not even, you're signing it through the IRS's system of inputting data from the previous tax year or whatever. Okay, so again, just to reiterate this, the due date is 9 months after date of death. You can get a 6-month extension. Okay, it has to be filed paper. The actual hard copy return has to be filed. Okay, now, in general, if estate tax is due, okay, the payment should accompany the return. Okay, and just like with an income tax return, okay, pay the taxes when you file the return. Okay, now there are options, as I mentioned a few minutes ago, for deferring payment or for setting up an installment plan. And that can vary depending on the type of assets that are in the estate, etc. I would refer you to Internal Revenue Code section 6166 if you just want to get a little bit of knowledge, or even better, talk to an accountant familiar with estate taxes and find out what can be done along those lines to arrange for payment, especially if the estate doesn't currently have the liquidity, in other words, the cash to make the payment, right? So that can be a problem. Now, you may be able to borrow the money against the assets in the estate, although that can be difficult. There aren't a lot of lenders who will lend money to an estate. Okay, they are out there. Okay, it's not cheap money from what I've seen. And so these are all the kinds of things that you'll want to look into if there's an estate tax that actually has to be paid. Okay, and your accountant will be a big help with that They know the rules. They may also have sources for getting cash to pay the taxes. They may know about a good source for that, and so that's something to look into, to talk to them about, and then look into. Okay, so but eventually the taxes have to be paid. It's not just a matter of filing the return. Now, if the return is being filed to port over excess exemption, so then there's no tax to be paid, so you don't have to worry about that. Okay, so there may be circumstances when all you need to do is file the return. You don't have to worry about paying any taxes because none are due. Okay, this is one of the big open issues with respect to the tax bill pending before Congress right now, is what's going to happen with the estate tax, right? Because if the exemption limit is not extended, it's projected, I've heard projections, it's going to drop to as low as $5 million up to maybe $7 million. So roughly a third to a half of what it is now, meaning a lot more estates could end up being liable for estate taxes. Okay. So the current tax law ends this year. Okay. So the extension or not will apply starting in 2026, and that's why those of us in this field are keeping track of things to see what's going to happen, so that as we work with our clients, advise them, etc., especially for estate planning attorneys, okay, or people like me. I have a multifamily office practice as well, so I need to be able to talk to my clients about what they need to do in terms of uh, not protecting themselves, but making sure an estate has the money to pay estate taxes if necessary. Okay, so you got to pay, if there are taxes due, you got to pay them. All right, and then excuse me. Finally, the IRS is going to receive the return, and it's going to go through a review. Okay, so there are different levels that it goes through: level 1, level 2, and so on. So uh, if there's no tax due, the IRS will review it, but probably that's it. You're done. Okay. If there's tax due, okay, and if the matter is in probate as opposed to in a trust or trusts, okay, so then not only will the IRS have to review it, but they will have to issue what's called a closing letter, meaning the taxes, the IRS has accepted the return and the taxes have been paid, and therefore this matter is closed. Okay, because the court may very well ask for the IRS closing letter to be submitted before it will allow the probate to be closed, because you're talking about a major potential debt to the estate, and it is the probate court's responsibility to make sure that all assets are marshaled and all debts are paid before the probate is closed. Okay, so as I said, I think toward the beginning, if the estate is liable for estate taxes, almost for sure, according to Roy, you're going to go through a level 1 audit. And I think you can see why, because they want to make sure that the proper tax is being paid. Okay. Now, and this is one of the reasons why it's so important to use qualified appraisers, qualified valuators in valuing and appraising the assets of the estate, because the deeper the IRS feels it needs to dig, the more likely it is that they're going to find some reason to assess additional taxes on the estate. Okay, so you want to make it, I know this may sound strange to you, to those of you who are tax averse like me, but you want to make it as easy as possible for the IRS to go, this is legitimate, okay, sign off. Right, and one of the ways to do that is by using qualified appraisers, business valuators, etc. Okay, so that process can take anywhere from, probably on the minimum, maybe about 6 months. it could take years. Okay, it could take a year, 2 years, even 3 years just to complete a level one audit. It depends. The estate tax division of the IRS is not very big because there aren't a lot of estates that are subject to taxation, but the work is fairly complex. And so it has to be done with a great deal of care. Okay. And so it can take time for it to work through. Now, if the IRS challenges a return, so it could wind on for a long, long time. If you're talking about multi-$100 million or even billion-dollar estates, okay, then the amount of taxes that the let's talk about a $1 billion estate. Theoretically, that could be liable for $400 million in estate taxes. Do you see? The IRS has a real strong incentive to look very closely at that estate to make sure they're maximizing collections. Okay, so it could take years and years and years for that return to get accepted, and for to pay the taxes, and for the IRS to issue a clearance letter. So that's why all of this, all the preparation is so important, and why it's so critical to make sure that you're using an accountant, or you're not using, working with an accountant who is very familiar with dealing with estate tax returns and estate taxes. Okay, now the IRS could choose to audit the return. They might decide to do their own valuations to contest the ones that you submitted, etc. And if you've ever been through an audit, it can be a pretty grinding process. Now, I will say that it is not always the case that just because the IRS challenges something, that A, they know what they're talking about, or B, that they win. So many years ago, when I had my previous real estate company, the IRS challenged the valuation of a piece of real estate here in California because the appraised value, which interestingly enough, I hadn't done, another appraiser had done it, even though it was one of my clients. The appraised value was lower than the value assessed for property taxes. Now, in many states, that wouldn't necessarily be a bad position for the IRS to take. But here in California, we have something called Prop 13. And except for the year in which the property changes hands and is reassessed, assessed value and market value don't have any relation. Okay, because assessed value can only increase a maximum of 2% per year. And because of that, the assessor does increase assessed values 2% per year, no matter what's happening in the marketplace. So this particular property, it had changed hands whenever it was, a number of years before. And so, the value, let's just say the value was assessed at $1 million. And over the ensuing 20 years, that $1 million increased 2% compounded for 20 years, I think went up to, whatever it was, $1.6 million. Okay. But because the market had declined for this particular type of property, at date of death, it was only worth something like $1.2 million. This isn't the actual numbers, I'm just using an example. So the IRS was contending, because the assessed value is 1.6 million, that was the proper value for the property, not the 1.2 million that the appraiser brought in. So my client approached me because he knew I dealt with these kind of complex issues. And I wrote a letter to the IRS showing them why the assessed value was higher than the market value. And, the IRS looked at that and they realized the mistake that they made, and they passed, they signed off on the $1.2 million value. Okay, so just because you get audited doesn't necessarily mean that the IRS is going to be correct in whatever it's claiming. It needs to be examined, and that doesn't mean that the auditor was stupid or anything like that. The auditor on this particular estate was in Colorado, and the property tax assessment system in Colorado is different than California. And by the way, this was also uh, much closer in time to Prop 13 passing, so it wasn't as well understood then as presumably it is today, where it's, the law is, I think, close to 50 years old now. So these are the kind of things where having competent professionals working with you as the personal representative are very, very important, so they can understand these more complex issues. Okay, but at some point, hopefully the IRS will accept the return. The taxes will be paid. You'll get your closing letter, and now you're done with the 706. Okay, so I've gone through a lot of fairly complex information, but I just want to take a minute to review the steps real quickly that you're going to go through as you fulfill this administration tax. First of all, determine if a 706 is required. Number two, collect the information. Three, get valuations of the various assets of the estate. Four, provide the information to your accountant so that he can calculate deductions and credits. Five, work with the accountant to prepare and file the 706. Number six, pay any tax due. And number seven, work through the IRS review and deal with any concerns so that you can get your closing letter. So that is the 706, the estate tax return process from an administrative standpoint. And I mean, taxes aren't necessarily an interesting subject for most people. I find it pretty interesting learning the ins and outs and the details. And I encourage you to learn as much about it as you can, because then you can work more effectively with your accountant in making sure that the best job is done for your clients, if you're a professional like me, or if you're an individual, to make sure that if you're both an executor and an heir, or a trustee and a beneficiary, that the best job is done both from a fiduciary standpoint, but also for the beneficiaries and or the heirs of the estate. Okay, so that's our show for today. I thank you very much for watching. Lamon, good to see you again, my friend. And tomorrow is at 10 a.m. Pacific time is my show, Business Lessons from the Military. And my topic is naval tradition meets business culture. I'm a Navy guy. And so I'm going to be talking about something called piping the side and how we can apply this to our businesses. And then on Wednesday at 10 a.m. is my show, People Making Money. And my show will be about permission to decline, how saying no builds wealth and sanity. It was one of the most difficult skills I had to develop earlier in my business career, was the ability to say no. It seems counterproductive to building a successful business, and indeed it is a crucial skill to build. So I'll be talking about that on Wednesday at 10 a.m. And then 7 days from today, I'll be back for the next edition of Trust and Estates Weekly. My guest will be Kelly Way, and she'll be talking about estate planning and intellectual property. I am really looking forward to talking to Kelly about this. Intellectual property, right? Things like books, movies, videos. This show that I'm doing right now is my intellectual property, right? How do you deal with that in estate planning? So please join me a week from today when I talk to Kelly Way about that. Okay, so once again, I thank you very much for joining me. Thanks to my sponsor, Probate and Trust TV. And if you have any thoughts, comments, please post on our social media. All the links will be in the show notes. And I haven't asked this for a while. If you are not a subscriber to the Way to Wow shows, please click that, or please consider clicking that subscribe button. Really would appreciate it. And that way you'll never miss any of our shows. So, again, thanks so much. Wishing you a wonderful rest of the day and signing off. Marie, darling, you are my bell. Courage at all times, my friends.